Are you an online educator struggling to find your audience? Quasar Markets connects you with learners looking for you. Keep 100% ownership of your courses. No hidden fees. Already have monetized content? Get paid again and again. Apply today. Take control of your educational empire. Quasar Markets, where educators build their legacy.
Good morning, Quasar Markets Live. I've got a really good one for you today. Dr. Ellman, he is the options king when it comes to strategy about how to make cash out of those options. Dr. Ellman, how are you, man?
Doing great, Steve. Always good to talk to you.
Absolutely. And you know, much as I like talking to you, I wish to get right into it. Let's get right into your presentation today. Traditional and defensive 5-day cash secured put trades from your premium stock report. So here we go, Dr. Ellman. I'll let you go.
Okay. So I trade about 100 to 150 contracts every month. You're going to see 3 of them in today's discussion. The strategies that I use, I'm on the sell side of options, Steve. So I use covered call writing. Today, we're going to talk about my other go-to strategy, which is cash secured puts. Now, one of the things that attracted me to these option strategies is that they can be crafted to your own personal risk tolerance and to what's going on in the market today. And that might be different from what's going on in the market next week or next month. But when I created these trades and executed these trades on August 11th with an August 15th expiration, so they were 5-day trades, I decided to do predominantly defensive. I did 2 defensive and 1 traditional. I'll show you how we quantify that and how I came to that decision. But you're going to be seeing 3 cash secured put trades, 2 defensive and 1 traditional. Let's move on. So what we're going to talk about now is selecting only elite performing securities, because our enemy is the price of the underlying stock, whether it's covered calls or cash secured puts. Our enemy is the price going down. So we want to select securities, stocks or ETFs that are less likely to go down. In other words, fundamentally sound, technically sound, with enough liquidity both on the stock side and on the option side. Then we have to determine the market direction. And we could use chart technicals for that as well, because in a bull market, we may do more traditional or more aggressive trading. In a bear, volatile, or uncertain market, which is what I feel we're in right now, we may want to take a more defensive posture. And so there's no right or wrong here. It's just that you evaluate things, you know your own personal risk tolerance, and then you set your trades accordingly. Now, another thing that you have to know up front is, what are you trying to accomplish? What kind of returns are you seeking? If you don't have that nailed down, how are you going to know which options to sell? So you have to have a pre-stated initial time value return goal range, and then run the calculations on those elite performers to see if those returns align with your goals. Now, once you execute the trades on your broker platform, then you get ready and prepare yourself for potential exit strategy opportunities. So that's what we're going to talk about over the next 15 minutes or so. Next slide, please. So why did I choose Arista? ANET is the ticker symbol. And you're looking right now at a little snippet from my premium stock report that we provide to our premium members every week, along with our weekly ETF report and monthly blue chip or Dow 30 report. And we have a quarterly high dividend yield report as well. Now, you could see I highlighted for you in the yellow row in the middle that ANET was in an industry rank of A. It was ranked 17 on the IBD 50, meaning that it was very strong from both fundamental and technical perspectives. Now, if you move over to the middle of the screenshot, you could see that the mean average rating, the MAR, was 1.45. The ranking that these analysts provide go from 1 to 5, 1 being the absolute best, 5 being the worst. So 145 is excellent, outstanding. Adjacent to that is the on balance volume, which is an up arrow, which is another bullish signal, meaning more cash flowing into the stock on up days than on down days. You see all the way to the right, the fifth column from the right, you see the implied volatility being over 30%, which is robust, perfect for selling options. And there was adequate liquidity. You see a Y in the column for near the money strikes having an adequate liquidity. So everything was in place. The earnings report you could see in the fourth column from the right did not interfere with the trades. So from a fundamental and technical perspective, ANET was a perfect candidate so far, but will the calculations also work out? Let me show you a little bit more about why I selected this as one of the securities in my portfolio for that week. Let's move on. Here is a 3-month price chart showing ANET versus the S&P. Now, the S&P is that blue line on the bottom. You see the blue arrow. And then the ANET is that orange or brown line on the top. Now, you could see that there was a point in time when ANET crossed over the line for the S&P, and since then headed to Mars. So in the last couple of months, ANET has been outperforming the S&P 500 exponentially. So that was another reason. Now we can get into more technical parameters, which I'll do in the next slide, as to why I selected ANET. Now on the top, number one, are the moving averages, which identify trend. Now, as far as moving averages, Steve, I use exponential moving averages because we're doing short-term trades, in this case 5 days, but I'll do up to a month. So we want to see that trend line moving quickly. Exponential moving averages put more weight on the more recent pricing. That's why I always, for 30 years now, have been using only exponential moving averages to identify trend as it relates to short-term option selling. If I was just using it for buying and selling stock, I'd probably go with the more traditional 50 and 200-day simple moving averages. But in any case, you could see the shorter-term 20-day EMI blue line is above the longer-term red line, which is 100-day EMA, and the price bars are at or above the 20-day EMA. Very bullish signal, number one. Number two, that's the MACD histogram, which is a trend and momentum indicator. And you can see those blue bars all the way to the far right in the middle of the screenshot are above the zero line, which is another bullish indicator where you see the green arrow. Now below that, number three is the stochastic oscillator, which is another momentum indicator. And you can see very recently it's been ascending, another bullish indicator. Now, are these bullish indicators for real? Well, we turn to volume at the bottom, number four, to see if volume is holding up. And you can see where I circled in that orange oval there. Yeah, yes, volume is very strong, meaning that the indicators 1, 2, and 3 are significant. And therefore, from a technical perspective, ANET is a very strong candidate at the time that I executed these trades. Let's move on, Steve. So I turn to the option chain. Can I sell options in a 5-day trade that will align with my return goal range? At the time, ANET was trading at 139.06. Now, for traditional, I would usually go slightly below, which is out of the money for puts. So I looked at the 136 out of the money, 5-day expiration, again, expiring on 8/15. Today's 8/11 when I made the slide. And it had a bid price of $1.12. We're going to feed this in to a spreadsheet that we created, the trade management calculator, in just a moment. But keep that in mind. The 136 out of the money strike had a bid price of $1.12 per share, 112 per contract. And I'm going to do one contract of that. Now, the 131, much deeper out of the money strike, same expiration, had a bid price of 29 cents. So there's the pros and cons of more defensive trades. More protection to the downside, lower premium return. But will it be significant? And that's what we have to find out. The takeaway here is that out of the money puts offer protection to the downside. Okay, that's one of the reasons I like to use these in bear, volatile, and uncertain markets. But Deeper out of the money puts, which I use 2 contracts on, even greater protection to the downside. And of course, the trade-off is lower option return. Next. So here we go, our trade management calculator, Steve. I show this just about at every discussion we have. I can't be without it. Since we developed it about 2.5 years ago, it's become a must-have for me and most of our members as well. And you can see on the top line here, with ANET trading at 139.06 on the top section in the blue rows, the 136 traditional, right, more aggressive strike generated $1.12, and below that on the top blue line we have the 131 deeper out of the money put generating 29 cents. So that's fed in. You'll notice all the way to the right on the top, I did 100 shares or 1 contract for the traditional 136 and 2 contracts of the more defensive 131. Now let's look at the bottom section here and take a look first at the traditional 136 out of the money put strike. You can see all the way to the bottom left, it's a 5-day trade. The spreadsheet calculates that for us. And let's look now at the break-even price point for that 136 put strike, and it brings us down to 134.88. All right. You'll notice that the deeper out of the money 131 put, where the blue arrow is, brings us all the way down to 130.71, meaning that as long as ANET doesn't go from 139.06 to below 130.71, we cannot lose money. That's a lot of distance to go in 5 days. And that's why it's a very defensive trade. But can we make money? That's the question. Can we make money? Let's first look in the brown cells on the bottom at the return, the 5-day return for the traditional 136 strike. That's 0.83%, annualizing out to over 60%. I would say yes, that's significant. Now, what if ANET drops from 139.06 to below the 136 traditional strike and we take no action to buy back that option? Well, then we'll purchase it at the break-even price point of 134.88, which represents, as you see in the purple cell, a discount of 3.01%. So, Steve, those are the 2 possible outcomes. Either generate a 60% annualized return or buy the shares at a 3.01% discount. Again, this is a 5-day return. Now, let's take a look. Go back to the last slide, please, Steve. Let's take a look at the return on the more defensive 131 strike, which you see in the pink cells. And that showed a 5-day return of 0.22%, annualizing out to 16.2%. Is that significant? Well, my opinion is yes, it is. And I say that because if your local bank put out information that they're now having a CD with a 16% annualized return, I would say the line would be around the block about 10 times. So yes, it is a significant return and much more defensive, because if you look in the blue cell, if the protection to the break even is 6%, it's like twice that of the traditional. And what is the break even? 130.71 from current market value of 139.06. So on this one screenshot alone, Steve, you could see the advantages of going traditional versus defensive, and you can craft your trades accordingly to your personal risk tolerance, to your overall market assessment. One size does not fit all, and there is no right or wrong. Now, once you enter these trades in your broker platform, then you go into position management mode. Now we can move on to the next screenshot. And this is just an example of how I locate. And this is just earningswhispers.com is one of the really good resources for locating earnings report dates. Zacks.com is another one. And the Quasar platform is going to be one of the best ever, coming soon. So yes, so you can see here that the earnings report is November 4th. It does not get in the way of our trade, because one of the important rules in options is to never ever sell an option if there's an upcoming earnings report. That's in the BCI methodology. That's my opinion, and a very strong one at that. So I use earningswhispers.com as one of my go-to resources for earnings reports. Let's move on. So here's my initial trade, just to summarize before we move on to the next slide. With the traditional, as I said, 0.83%, 60% annualized, and 3.01% protection to break even. That's very good protection for a 5-day trade. Now, for the deeper out of the money defensive put, 0.22%, 16% annualized, with 6% protection to break even. So the total amount of time value premium that I collected on these 3 contracts was $170. Now, I warn everybody watching this presentation, do not go by dollar amounts, go by percentages. I trade between 100 and 150 contracts every month. I'm showing you 3 of them. So although $170 may not seem like a big deal, in the world of options, we have to look at the percent returns, which I just showed to you, and then it becomes significant. Next. This is a screenshot showing my broker confirmation of these 3 contracts. So one contract, the traditional, was filled at $112 for the contract. It's shown on a per share basis. And 2 contracts of the defensive 131 put at 29 cents a share, $29 a contract, $58 for the 2 contracts. So that just shows you the screenshot that when I went to my broker to just confirm that these trades were in fact executed. Next slide. Now, our spreadsheet will also do total portfolio returns. You saw per trade in a couple of screenshots ago, but if these were the only trades that I executed, then it would show you, okay, how many contracts for the portfolio? 3, 2 plus 1. How much cash was generated in these 3 trades? Time value, $170. How much capital was invested? Well, to secure a put, you take your put strike, deduct the put premium, multiply it by 100, and then multiply it by the number of contracts. And that came to $39,630. And that was a return of 0.43%. Annualized, combined, this is the combined annualized return for the 3 contracts, 31.39%. Significant? I say yes. Let's move on. So now we're going to go back to expiration of the contract. ANET was trading at 137.30. You recall that the strikes that I used were 136 and 131. So I didn't really have to do anything. Exit strategies were not needed. All I had to do was just collect my money. Now, so both of the contracts expired out of the money and therefore worthless. And what that does is it releases the 39,000 plus that I needed to secure those 3 put contract trades. And then on Monday, I would reuse that cash for more put secured trades. My final realized, because I know I made this now, 5-day return was 0.43%, 31.39% annualized. Now, folks, I'm not here to tell you that every single one of your trades is going to be as successful as these. No, as a matter of fact, in upcoming discussions with Quasar and Steve, I'll actually show you some that weren't winners, but maybe mitigated with exit strategies, because not every single trade is going to be a winner. But if you do everything that you saw in this discussion, starting from stock selection, evaluating the overall market, setting up your trades based on your personal risk tolerance and market assessment, checking to make sure that your returns align with your pre-stated initial time value return goal range, and then prepare for exit strategy opportunities, you're going to be doing better than everybody else. That I can promise you. In any case, these were all successful, but keep in mind that these are low risk trades. They are not no risk trades. This is the world that I live in. I'm a conservative investor with capital preservation critical, but I want to beat no risk returns. I've been doing it for 30 years successfully, and I'm happy to share this information with you, Steve, and everybody a member of Quasar. Let's move on to the next slide. Let's just summarize now. You can get significant returns even with just 5-day, whether it's traditional or defensive trades. Use your personal risk tolerance and overall market assessment to determine how you're going to structure your trades. In the past, it always used to be, pick a stock, sell the option, one size fits all, always go 15% out of the money or whatever. No, it should be based on many, many other factors, a lot of which you saw in this discussion. And remember that once you enter the trade, be prepared with your exit strategy arsenal, perhaps something that I'll touch upon in future discussions. And Steve, if you move to the next slide, I think that's it. Yes, it is. So, Steve, appreciate the invitation to speak with you every week. I know that a lot of people look to you for information on the stock market, on stock options, and I'm so happy to be part of the Quasar family.
Yeah, Dr. Ellman, Alan to me, obviously, but blue collar investor. I think one of the things that people don't understand is options are tough, and you boil it down, and they're no longer tough anymore, right? Once you get it, once it clicks, it becomes part of your repertoire of how you invest. And I think a lot of people need to understand that. And it's very interesting, bluecollarinvestor.com. It's real simple. Just go click on that button, and you'll be able to go see Alan and his whole team. Get that calendar. Listen, we all live by that calendar now if you're looking for those cash coming out of options. And I am very proud and happy to call him a friend and part of the Quasar Markets family.
Yeah, Steve, you're right. A lot of people get very intimidated about options. And I always use an analogy, if I can just give you a quick analogy.
Yeah.
A lot of my live presentations. I remember when I was 17, 16 maybe, I was learning how to drive. And my father used to take me out like early in the morning on Sundays when the one day he didn't work, like 6 in the morning to a local shopping center with no cars in the shopping center. And he would start teaching me how to drive. And boy, was I confident that I'm driving around, no car. Then one day he said to me, Alan, it's time to hit the road. Let's go on the highway. And I was scared to death. I couldn't believe he was going to make me do this. Cars going 65 miles an hour, the twists and turns in the road, all these signs that I didn't have to deal with in the parking lot. And I was very intimidated. And then over time, as I did it more and more and more, I got more and more confident. And today, lo and behold, like all of us here, you get in your car and you go. And that's how it's going to be with options. Once you learn it, educate yourself, paper trade a little bit, practice, and then go start executing these trades, you'll have years and decades of generating cash flow into your portfolios that you didn't have before.
Well, ladies and gentlemen, Dr. Alan Ellman. Alan, we'll see you right back here next week, man.
Take care, Steve.